I was looking through this Form 10K for Amazon's 2025 fiscal year.
Oh, yeah, the annual report.
Yeah, exactly. The one ending December 31st. And honestly, it almost feels weird to keep calling them a retailer.
Right. I mean, they are, but
Right. But the sheer scale of the numbers here is it's hard to wrap your head around. Over $716 billion in net sales.
it's massive. It's an economy unto itself at this point.
It really is. But if you're joining us for this deep dive, our mission today isn't just to gawk at that top line revenue. We're getting into the real story here.
Because the real story is definitely not just about selling packages anymore.
No, not at all. It's about this massive, violent pivot toward artificial intelligence. It's about how they're handling billions in legal settlements. And honestly, my favorite part, we are going to unpack how some very specific accounting changes, specifically around computer servers, shifted their bottom line by billions.
Yeah, that use of estimate section is fascinating. And we really need to look at the risk factors, too. Things like the AI chip shortage or regulators labeling them as a gatekeeper. There are huge headwinds hiding behind that $700 billion revenue number.
Exactly. So let's start in the engine room.
AWS.
AWS, yeah. Amazon Web Services. The cloud computing arm. The growth here is just relentless. Sales grew 20% in 2025.
Which brought them to, what, 128 billion?
128.7 billion, but the operating income is the number that jumped out at me. $45.6 billion.
That is the profit engine of the entire company right there. That cloud income is heavily subsidizing the retail side. But you mentioned the accounting changes earlier, and I think this is the perfect time to bring up that aha moment from the report.
Right, the use of estimates section. I have this flagged. So effective January 1st, 2025, Amazon actually changed the estimated useful life of a subset of their servers and networking equipment.
They did, and this is such a critical detail.
They dropped the lifespan from 6 years down to 5 years, which on paper sounds like a minor bookkeeping tweak.
Right, you might think, oh, they're just updating their spreadsheets. But for years, cloud providers have been extending the life of their servers to squeeze out more profit margins, moving from 4 years to 5, then 5 to 6.
And now they're going backward.
Exactly. They are reversing the trend. And the reason they give is the rapid pace of technology development, specifically in AI and machine learning.
Because AI workloads they cook these machines, don't they?
They absolutely do. Training large language models isn't like hosting a static website. You're running clusters of GPUs at max capacity, constant thermal stress for weeks or months. The physical hardware is literally degrading faster because the compute demand is so intense.
So they have to cycle out the hardware sooner. And that has a massive financial penalty.
A huge penalty.
The report says this single accounting change increased their depreciation expense by $1.4 billion. And it reduced their net income for the year by a flat $1 billion, just vaporized.
Because the hardware just can't keep up. It signals that to stay relevant in the AI era, tech companies are going to face much faster, much more vicious reinvestment cycles. You can't just sit on your servers for 6 years anymore.
You have to constantly buy the new stuff.
Right.
Which brings us to the other side of their AI strategy. If AWS is their infrastructure bet, then Anthropic is their lottery ticket.
Yeah, Anthropic PBC, the AI research company behind the Claude models.
Exactly. And this gets into the other income line of the 10K, which is, frankly, it's wild. So in 2024, Amazon's other income expense net was a $2.3 billion loss.
Right.
But in 2025, it swung to a $15.2 billion gain.
It's a staggering swing. And it all traces back to how they structured their investments in Anthropic.
Walk me through that, because they invested billions.
We did.
Think
Between
about-
Q3 of 2023 and Q4 of 2024, they pumped over $5.3 billion into Anthropic using convertible notes. And they added even more in 2025.
Okay, convertible notes. So that's debt that can turn into equity.
Exactly. And 2025, some of those notes actually converted into non-voting preferred stock.
And here's the kicker. Because of the AI boom, the valuation of Anthropic has absolutely skyrocketed.
Right. So when those notes converted, Amazon had to revalue that asset on their books based on observable price changes in the market.
So they didn't actually sell the stock. They just looked at it and said, this is worth way more now.
Precisely. It's a paper gain. In the third quarter of 2025 alone, they recorded an upward adjustment of $7.2 billion.
Wow.
Just from that revaluation. So when you see that massive $15 billion gain in other income, You have to realize that a huge chunk of that is essentially unrealized profit from a strategic AI investment.
It makes their net income look incredible for the year, but it's not cash in the bank.
No, it's not.
Which means if you strip out those paper games, you are left looking at what I'd call the messy middle of this income statement.
Yeah, the legal and regulatory costs, it was a very expensive year for Amazon's lawyers.
Extremely. Let's look at the FTC settlement. In Q3 of 2025, they recorded a $2.5 billion expense to settle a lawsuit with the Federal Trade Commission.
$2.5 billion.
Yeah, and the report is careful with the wording, but this stems from the long-running antitrust scrutiny over how they operate their fulfillment network and Prime.
Right. The allegations that they basically forced third-party sellers to use Amazon Logistics if they wanted the Prime batch. Yeah. To write a $2.5 billion check to settle that, it tells you they really wanted to clear the deck.
But the deck isn't totally clear, because in Q4, they took another $1.1 billion hit.
For international disputes, right?
Yes, specifically resolving tax disputes associated with their store's business in Italy, along with a few other international legal settlements.
So that's $3.6 billion in settlements in the back half of the year alone. But honestly, the bigger threat isn't the settlements, it's in the risk factors section.
You're talking about the gatekeeper designation.
Yes. The 10K explicitly warns about regulators characterizing technology companies as online gatekeepers. This is mostly coming from the European Union.
The Digital Markets Act.
Exactly. When you get labeled a gatekeeper, the compliance costs skyrocket, and more importantly, it limits your operations. Regulators can stop you from prioritizing your own private label products over competitors.
So it breaks the whole Amazon flywheel.
It threatens the core efficiency of how their marketplace operates. But there's another risk factor in that section that I think is even more immediate.
The AI supply chain one.
Yes. They actually put a specific warning in the 10K about relying on a limited group of suppliers for AI infrastructure, specifically graphics processing units, or GPUs.
They don't name names, but they mean NVIDIA.
Of course they mean NVIDIA.
Which is such a weird position for Amazon to be in. Normally, if Amazon needs something, they build it themselves. They control their destiny. But here, they're completely reliant on a third party to supply the actual chips they need to build out their cloud.
And if those suppliers have a shortage or favor a competitor, Amazon's entire AI expansion could stall. It's a massive vulnerability.
Speaking of massive, let's pivot to the retail machine. North America and international segments.
The original business.
Right. North America's sales were up 10% to $426 billion. International was up 13% to $161.9 billion.
Though we should note the international growth was definitely helped by favorable foreign exchange rates.
True. The report says FX rates added about $4.9 billion to the international top line, but the number that really stopped me in my tracks was the fulfillment and shipping costs.
It's the physical reality of moving all those boxes.
Total fulfillment costs hit $109 billion, and shipping costs alone, just shipping, was $102.7 billion.
They crossed the $100 billion mark just to get stuff to people's front doors.
It's hard to even conceptualize that much money being spent on postage and delivery vans. But while they're spending all this money moving goods, they are actually pulling back on their physical footprint.
The asset impairments.
Yes. In 2025, they recorded approximately $1.3 billion in asset impairments. The report says this is primarily related to property, equipment, and operating leases for physical stores.
But mostly in North America, right?
Right. So this is them looking at their Amazon Fresh or Amazon Go stores and realizing those assets aren't worth what they thought.
Brick-and-mortar retail is notoriously difficult, even for Amazon.
And it wasn't just physical stores that took a hit. They recorded $2.7 billion in estimated severance costs.
$2.7 billion just in severance. That is a massive workforce reduction.
It is. And the 10K notes this impacted all segments. Fulfillment, technology, and sales. They're trimming roles everywhere.
It really paints a picture of a company reallocating its resources. They are cutting back on experimental physical stores and reducing headcount, likely to free up capital for this massive AI infrastructure build-out we've been talking about.
Which leads us perfectly into how they are funding all of this. We need to talk about their tax policy and their cash flow.
The tax section of this year's report is very revealing.
It is, and there's a specific piece of legislation driving this. The 10K cites the One Big Beautiful Bill Act of 2025. Now, obviously, that bill generated a lot of political debate from all sides when it was passed.
Right, but looking strictly at the text of the source material and how it impacts Amazon's bottom line, the mechanics are what matter here.
Exactly. We are just looking at the math and impartially reporting what the 10K says. So what does this act actually do for their tax burden?
Two major things. First, it reinstated 100% accelerated depreciation deductions on qualified property,
Yeah.
retroactive to January 2025.
Meaning what, practically?
Practically, if Amazon buys $1 billion worth of servers this year, instead of writing off that cost slowly over 5 years, they can deduct the entire $1 billion from their taxable income immediately.
Which is a huge incentive to spend money on physical assets right now.
Exactly. And the second thing the act did was allow for immediate expensing of domestic R&D costs.
So the result of this, and this is wild, is that despite making more profit in 2025, the actual cash taxes they paid dropped significantly.
Yeah, they paid $12.3 billion in the prior year. In 2025, cash taxes paid were down to $8.3 billion.
A $4 billion drop in taxes paid, fueled directly by reinvesting in their own infrastructure and R&D.
Which brings us to the cash flow statement. Because the scale of that reinvestment is the defining feature of Amazon in 2025.
I have these numbers circled. Cash provided by operating activities, so the cash the business actually generated from doing its thing, jumped to $139.5 billion.
A phenomenal amount of operating cash.
But then you look down at the capital expenditures line. Purchases of property and equipment, $128.3 billion.
They generated $139 billion, and they immediately turned around and spent $128 billion of it on gear and buildings.
That is almost all of their operating cash going straight back into the ground. Data centers, fiber, servers.
The push for AI infrastructure and fulfillment capacity is just absorbing every dollar they make.
And if we look ahead to 2026, it doesn't seem like they have any intention of slowing down.
No, the guidance for Q1 of 2026 projects net sales between $173.5 billion and $178.5 billion.
And there's a really interesting detail hidden in that guidance regarding a new initiative, Project Amazon Leo.
Right, the satellite network.
Yeah, the 10K describes it as a satellite network for global broadband service. And they specifically state that their operating income in 2026 will be impacted by approximately $1 billion of higher year-over-year costs just as Project Leo scales up.
Building a constellation of satellites to compete in global broadband is incredibly capital intensive. $1 billion is just the start.
The guidance also mentions they are going to be investing in quick commerce and pushing for sharper pricing in their international stores.
Sharper pricing is corporate speak for price cuts. They're willing to compress their own margins internationally to capture market share.
But they are going to face some unique international risks doing that, right? The 10K was pretty explicit about geopolitical headwinds this year.
Yes, specifically in China and India. The risk factors call out stringent regulatory environments, including foreign ownership restrictions.
And data localization laws.
That's a huge one for AWS. If a country mandates that data generated within its borders must be stored on servers physically located within those borders, Amazon has to build entirely separate, redundant infrastructure just for that country.
It fragments the cloud. You lose all the efficiency of a centralized data center.
Exactly. It makes that $128 billion capital expenditure bill even heavier. And we can't ignore the environmental risks they highlighted either.
The transition to a low-carbon economy.
Right. They note that complying with new climate regulations and transitioning their operations, especially given how power-hungry all those new AI servers are, is going to require significantly increased investment.
So if we pull all of this together, we're looking at a 2025 where Amazon brought in over $700 billion in sales.
Right.
But beneath that, they basically restructured their future. They shortened the lifespan of their servers, acknowledging the brutal hardware reality of the AI race.
They reaped massive paper gains from their Anthropic investment, while simultaneously paying out nearly $4 billion to settle antitrust and tax disputes.
And they took advantage of the 2025 Tax Act to pour a record-breaking $128 billion into capital expenditures.
It really was a year of acceleration.
It was. Which leaves us with a pretty provocative thought to mull over. Amazon is spending nearly as much on capital expenditures as they are generating in operating cash.
It's a razor-thin margin.
With server lifespans shrinking and the race for AI chips intensifying, you have to ask, can they actually sustain this level of aggressive reinvestment? And if the AI payoff takes longer than expected, are they going to have to start squeezing the retail customer or the third-party seller just to fund the data centers?
It's the ultimate balancing act. They are betting the entire company's cash flow on an AI future that is still being written.
It's going to be fascinating to watch. Well, thank you for joining us for this deep dive into the financials of a true tech giant. We'll catch you on the next one.